And to speak more on this, I'm joined now by Ajay Bagga, Chairman of Elements Platform, and market expert Arnab Das, also with me. He's a global market strategist. Welcome to both of you, and thank you so much for speaking with us. So the bulls are back on Dalal Street. We've had this very interesting conversation with Chris Wood, who's also pointing, to a good story moving ahead. Ajay Bagga, do you think that the tide has turned?
Yeah, for India, the tide has definitely turned, and in his recent greed and fear report of 25th May, and as well as their presentation at their firm's India Forum last week, they brought out about 10-15 such points, Tamanna. So a lot of things have been working out well for India. I think the biggest boost for India is the domestic money coming in. Mutual funds have seen net inflows of $20 billion over the last 12 months. We are seeing SIPs of nearly 14,000 crores a month. And that is still, less than about 4% of the household savings. So still a big way to go for domestic flows. And when the foreign flows have turned, as has happened since April first week, we have seen that it's been a double-paced recovery from an underperforming market. India has gained very fast. The big issue for India will be twofold. One is the national election that is due, say, around February of next year, and results will be out end April, early May. So 2024 national elections could be a dampener for sentiments. And second would be an external risk of event. The biggest risk for us is some external risk of event, and where there is no decoupling because of the flows being so interrelated. Though this time, unlike 2008, the domestic story is very strong. The macro is strong, the socioeconomics is strong, and the sheer inflows from the domestics is very strong. So hopefully, an external risk off will not lead to as sharp a cut as we saw in 2008, but that would remain the big risk event for us.
I actually want to play out what Chris Wood said on this, on challenges ahead and the role of elections coming in, because that seems to be the big question. And the timing is interesting as the current government is marking its 9th year in power as well. Let's just listen in to what Chris Wood said there.
The monetary tightening cycle has peaked. The corporate sector is the big corporates are very underleveraged. The banking sector NBL situation is cleaned up. We've just entered the third year of a residential property market upturn, which in my view can run for another 5 years. And we have I admit it's only early, but we have early indications that a private sector capex cycle is going to happen. Meanwhile, the Indian government has been running quite big fiscal deficits, but those deficits have been primarily used to finance a big infrastructure build-up, not to finance transfer payments, and visibly you see dramatic improvement in infrastructure. So yes, I think the stars are pretty well aligned. Where the market will probably, in my view, continue to climb a wall of worry, but you are, in 6 months' time, you're going to get growing focus on the election, and that, if there's, you're going to get people, there's going to be speculation on a change in government. So if there was a change in government, which is not my base case next year, that would not be viewed positively by most foreign fund managers.
Chris, a few Indian sweets, if you wish, you can try them. This is called Indian dhokla, and you eat it with chutney. Maybe after the interaction, we can, you may want to taste some Indian sweets. By the way, do you like Indian food?
I love it. I don't eat sweets. But I eat too much Indian food at night.
Which is your all-time favorite? Which is your all-time favorite Indian dish?
Rogan Josh.
Yeah.
I always order Rogan Josh.
Yeah, with the naan.
Yes. Well,
You must stick around for that full interview with all those moments with Chris Wood. But I want to talk about the point he made about the next elections and how that will become a big factor even for foreign investors in the next 6 months. Arnab Das, I'd like your view on that. Is that something that you're penciling in as far as India is concerned?
Yeah, I think after the loss by the BJP in Karnataka, people have to be thinking about the general election as well. Look, I think it's important to keep an eye on politics and the electoral process in any country, especially in India. But I think the key thing is that the policies need to keep moving in the right direction. Right, there needs to be continued liberalization of the domestic economy, and there needs to be, I would suggest, greater emphasis, let's call it, on make in India, right? And I think one of the great things about India is that there's a very large domestic market. It's a very low-cost labor force in many respects, but productivity is very low. So liberalizing the domestic economy and liberalizing the labor market, liberalizing land acquisition, liberalizing vis-a-vis the bureaucracy, and perhaps disinvestment, all these things could raise productivity quite sharply and enable India to catch up quite rapidly at a time when the world economy is changing. Right? I wouldn't say there's decoupling going on, but there's de-risking is the big buzzword, and I think it is clear that if India could really mobilize this idea of make in India, there could be a manufacturing boom, but there is unlikely to be one unless there's further liberalization. Manufacturing could grow, but maybe not boom without that kind of liberalization. And so in many respects, this could be India's moment and should be India's moment, but it's not set in stone. It depends on what this government and the next government and subsequent governments do. And I think it's high time for India to start catching up in that regard. After all, no country has made it into a higher and higher income status, $5 trillion economy, $10 trillion economy, whatever target you want to set, without a substantial manufacturing sector. And so I think that's where the emphasis needs to be, is on policies that both support the existing strong services sector, support the existing strong consumer economy, but also generate a lot more uptick in manufacturing.
Glad you spoke about that, because that's another thing that we asked Chris Wood about, and I just want to play out his comment on Indian manufacturing.
So there's a greater optimism on the capex, I would say, than what I was fully aware of. The property market, it's actually stronger, but the thing is, it's not, the one weakness on the property market is in the affordable housing area. So all the actions in the middle segment and the high-end segment.
If the Indian economy moves from $3 trillion to $5 trillion, what we debate every day, it's not if, it's the time duration, whether it's 2 years, 3 years, or 5 years. But if the economy goes from 3 trillion to 5 trillion in 3 to 4 years, where do you think the earning entrepreneurship engine would be unleashed? Where do you think, which sector do you think will see the maximum tailwind?
Well, no, there's another whole thing going on, which is a new development. That's obviously the hope that India can build real manufacturing
Supply chain.
And this is partly based on the production-linked incentive schemes, but more importantly, is based on this fundamental reality that all these multinationals, particularly US multinationals, can no longer afford to have all their eggs in one basket in China. So the best example of that is clearly Apple. Apple had all its production in China because China is the most efficient place to produce. It still is. But if I'm running Apple, another major US concern, given this geopolitics right now, you have to build another production facility somewhere else because you have the risk that one day the US Congress orders you out of China. Yep. Because
that's an interesting point. Ajay Bagga, I want to come to you on that. What we're seeing in India right now, broadly, a couple of things have happened short term. The US debt ceiling fear seems to have been, put aside for now, and we've had some interesting conversations on that. You've had FIIs coming back with a bang, and a sputtering China perhaps pointing more and more clearly that India is the next best option?
Tamanna, what has changed over the last 2 years is people have realized that supply chain issues and the economic coercion that China practices as a matter of state policy. They economically they coerce Western companies to give up their trade secrets and their patented technologies. Secondly, they are able to put pressure in terms of being huge suppliers. So nearshoring, friendshoring, reshoring, these have really taken on a huge dimension. And a country like India could really come as a friendshoring case. We saw the announcements today where a lot of big economies are getting together and trying to recalibrate their supply chains so that they are not so dependent on the Chinese. And there will be a huge differentiation in terms of what export controls are levied on the Chinese. Second, there will be a conscious move to de-risk out of China. So India can be a beneficiary. There are 300,000 figures, Tamanna, today. One is Chris Wood talking about the Sensex going from 60,000 to 100,000 level over the next 5 years as a big possibility. At 15% corporate earnings growth, mathematically you get it. Two other numbers I would like to quote. One is our defense production, local defense production crossed 100,000 crores this year. And third, the public sector, the 12 public sector banks, Tamanna, this year, they yielded a profit of 104,000 crores, which is after 12 years, we have seen a huge 2-year surge in the public sector banks. So that twin balance sheet issue that we had in 2013 of very leveraged corporates and banks which had huge NPAs and were not able to lend, were at the risk of going into liquidation themselves. That twin balance sheet issue has been erased from the economy. The profits to GDP ratio has come back to very sustainable numbers like 4.5%. It had fallen as low as 2%. And the third big thing is we have seen in the PLI based sectors that there is a big uptick coming in. We have the cachet of resources, we have the cachet of rule of law and the population available, very highly skilled population. What has been the issue for us is local level corruption and very bureaucratic red tape. Hopefully with this PLI and this identification at the government's end that you need a strong, what Mr. Das also mentioned, you can't run a service economy of 55% of GDP and hope to be a 5 trillion, $10 trillion economy. You will have to have move from 15% manufacturing to 25 to 30% kind of manufacturing if you really want to reach those $10 trillion levels. So I think the opportunity is huge and across the political spectrum. I remember 2009, I was working in a foreign company and we actually had to make a presentation to our head office because if you remember that time, it was looking like a coalition government where, the heartland parties could be kingmakers and we could have had a 1996 kind of issue. So the problem for 2024 will be how clear is the mandate for either side, because both will pursue a developmental agenda that there is no going back. But if it's a coalition that comes in, that could spoil the party. So I think that's why the next 6 months, 6 months from now, as February looms larger, you could have some amount of sideways movement in flows and the markets.
Having said that, the kind of trajectory that we saw from 2019, and of course that work was continued in 2014, maybe belied that massive drop we saw that day. And I remember that as well, Ajay Bagga. I was reporting on that day on Dalal Street, and people were in panic. Yeah, it's in hindsight, perhaps there was no need for that extent of panic. Now, since we're talking about a broad optimism, let's talk a bit about themes. And I'll play out in a bit what Chris Wood said. Interestingly, he likes real estate. That everyone has not been, so excited about for a while. I just want to get your views on that, Ajay.
Yeah. You are looking at 6.5% as the policy rate right now. And April, the trailing inflation was 4.7%. The core inflation in April came at 5.2%. So you moved to a positive real interest rate scenario. And our own estimate is that given an incipient slowdown, we saw the German economy having a bit of a slowdown. We are expecting a more earnings recession and then leading into an economic slowdown, maybe not a full-blown recession in a technical sense, but an earnings recession is definitely there. We have had 3 quarters of S&P 500 EPS going into negative earnings growth from last quarter of last year onwards. And we are expecting that this quarter also, right now analysts are talking of -6%. Maybe it comes at -3, just like the trailing one quarter. We are expecting in that scenario that RBI cuts rates by October, November. We actually start seeing a rate cut because the task has really been done. So that is giving a boost to the markets that the rate hike cycle has probably come to an end in India in April, and the pause will be followed by rate cuts by October, November. To take care of the risk of coming from the external economy, the global economy. So talking about real estate, Chris Wood has plotted the entire cycle. And the good thing in real estate is one, the huge environment that has grown in terms of the housing loan availability and the affordability of those EMIs. That is one. Second, the big segments which have been able to buy housing because of a huge increase in income levels. Affordable housing has still not picked up as well. It's more the middle class and the luxury segments. Third is the inventory cleanup that has happened. And fourth is the government legislation like RERA, like the IBC, where there is some amount of protection. And 95% of the mom and pop developers have been bankrupted out in the last cycle, Tamanna. So that has given a lot of strength to the survivors. I remember Anshu Jain would always tell us, even whenever there was a recession and we would be doing internal reviews, and he would say the survivors will come out very strong. I remember 2008-9, when in March 2009, when everything looked very grim. We didn't realize at that time that that was the bottom of the stock markets. And he said, whoever survives will really eat the market share. And these now the listed real estate companies have really survived the last 10, 12 years. We have come from a fragile 5 scenario of 2013, where now these companies are very strongly capitalized. They have the funding available, and the end consumer has the funding. So real estate, especially in the residential, is doing very well. I was talking to an alternatives manager. He was making a big comparison of US commercial real estate versus India. Indian commercial real estate is still doing very well. Our REITs, InvITs, if you see, have largely done quite well as well, across infra, across construction. And lastly, Tamanna, what happens as the real estate cycle takes off? Construction is one of the biggest employers in India. After agriculture and after textiles, construction comes very near, and there are a lot of supplier companies of various sorts, right from metals to cement to housing equipment, plus the rural economy takes off when construction does well, because the domestic remittance economy, the migrant economy, it gets a boost. And that we are seeing. The economy which had really declined due to COVID, we are seeing the domestic migrant economy, the remittances starting because the construction, both on the infrastructure side and on the real estate side, both is contributing to that remittance economy coming back strongly.
That's an interesting idea, because real estate was nobody's favorite for quite a while, and then there's a saying, what doesn't kill you makes you stronger. I'm going to just play out what Chris Wood said on his outlook on real estate.
There is a consensus view on owning banks, but I'm going to still own the banks. I've been running my Asia ex Japan long only greed and fear portfolio since 2002. So I would say in the more than 20 years that portfolio has existed, if there's one sector where there's always been an allocation in an Asian context, let alone an Indian context, it's Indian private sector banks. So to me, that story remains intact. That's the most straightforward story in India. So if there's a global investor who wants to invest in India and hasn't got the bandwidth to invest in lots of stocks, that's probably where they're going to invest. But right now, with the monetary tightening cycle over, the obvious place to add to, at least I think it's over, the obvious place to add to exposure is property stocks. So the property stocks went vertical in 2022.
22, yes.
When we got second half of 22, they went vertical because suddenly the market realized the property upturn was finally happening after a 7-year downturn. Last year, they corrected because we're in a monetary tightening cycle. But actually, the property market kept the actual physical property market kept recovering. So the moment we get hint of easing, the property market stocks will do very well.
So can I say,
the property stocks will do well.
Yeah. So can I say that Chris Wood is in fact urging our viewers that don't buy real estate, but buy real estate stocks in India?
Well, right now, that's the safer trade, but I think they'll both be going up. The other point about real estate is because you had this dramatic, when I say dramatic.
From Arnab Das, while we wrap this up, so Chris Wood today, he spoke to us, and the headlines are all about saying the Sensex will cross 1 lakh. Do you have a figure in mind or a timeline in mind, Arnab?
No, we tend not to try to avoid making point forecasts, especially with timing attached to them.
We love the headlines. We love the headlines.
Yeah. Absolutely, as well you should. Look, I think the challenge with the Indian market for many foreign investors, especially institutional investors, is that although there's a lot of deeply attractive stocks, there's a lot of diversification possibilities. It's a very large and relatively well diversified market. It tends to be a perennially rich market. Richly valued compared to others, I would say for good reason. I think the things that we've been talking about, right, the end of the rate hiking cycle, the probably what we think of as a bumpy landing in the world economy rather than a hard landing or a recession in the U.S. and many other countries. All of these things are probably quite supportive. I think the key thing is the domestic policy environment. Not just monetary policy and the RBI, but beyond that, as we've been discussing, right, deregulation and encouraging CapEx, inward investment by foreign corporations, internal investment by domestic corporations, integration of the Indian market. All these things are happening. So I think, I tend to agree. I think things are pointing all in the right direction, despite the rich valuations. I think there's some room for political turbulence, as we've also been discussing. Going into the elections, but I do think people are paid to take the long view, not to have a specific target of 100,000 of 1 lakh or a specific time frame for that in mind. But the general direction of travel is very much the right one. So I think everybody needs to be invested. And I totally agree with Ajay Bagga's point that the domestic flow is very strong, and that will likely continue because financial inclusion is increasing. Financial deepening is increasing and incomes are rising. Indian people are going to be earning and saving more and putting a significant amount of that into the stock market. So I think everything is pointing in the right direction. The valuations being rich notwithstanding. Okay, so no target, but a general direction upward and onward.
That's good enough. Thank you so much, Ajay Bagga and Arnab for speaking with us this Monday evening as we look at a pretty good start to trade this week. And